Good morning, everyone. I'm Amanda Gerber, Marketing Director with DWD. Thank you for your interest in our session today, Unrelated Business Income. Do you need to file a 990T? For those of you that have questions that arise during today's presentation, please submit them using the Q&A feature. We will be answering the questions throughout the presentation and allowing some additional time at the end. With us presenting today is Nonprofit Services Director Carrie Minnick. And we also have team members Susan Berghoff and Tyson Moore with us today. They will be helping to answer the submitted questions as well. At this time, I will turn it over to Carrie to get started.
Thanks, Amanda. Today, we're going to talk about unrelated business income, and this is a very gray area, very dependent on the individual circumstances of the organization. So let's first just kind of break down today's topics. First, we're going to start by defining exactly what unrelated business income is, and then go into some specifically excluded activities and income. And then we're going to talk about some very common unrelated business income that that we see more often with organizations: rent income, advertising. Then we'll touch a little bit on qualified sponsorship payments, which is not unrelated business income. And then finally, we'll talk about operating more than one unrelated trade or business. And then finally, Form 990T. And before we get started, just wanted to run a few acronyms by you. UBI is unrelated business income. UBTI is unrelated business taxable income. And then UBIT, UBIT, is unrelated business income taxes. So I might be using those acronyms throughout the webinar today, so that way you can know what I'm referring to. So the operation of an unrelated trade or business may jeopardize an organization's exempt status if the activity becomes the organization's primary purpose. Even if it is not the primary purpose of an organization, the activity still may be subject to UBIT, so you may have to pay taxes on it. The intention of UBIT is to put tax-exempt entities and for-profit enterprises on equal footing with respect to their trade or business activities. So for example, if a for-profit company down the street is doing the exact same activity as you as a nonprofit, why do they have to pay income taxes on the activity while you do not? So UBIT tries to make it an equal playing field. Unrelated business income determinations are almost always totally dependent on a particular facts and circumstances analysis. So just because one nonprofit reports UBI related to the conducting of a particular activity does not mean that another nonprofit conducting the exact same activity will also recognize UBI. So again, it's very dependent on the specific facts and circumstances of your organization. One other thing to note is that the IRS does ask on the annual Form 990 whether the organization undertook any new significant program service activities during the year. So for example, if you had any changes to your programming, added new programming, it's always good to make sure that you answer this and describe what those new activities are. Because if you do not, the IRS may consider those new activities unrelated business, trade or activity, and may require you to pay taxes on those. So just a reminder there that when you're filling out that 990 to answer that question appropriately. So first, we're going to talk exactly about what is unrelated trade or business. So an activity is an unrelated trade or business if all three of the following conditions exist. So all three must exist, not just one or two, but all three. The first, the organization is conducting a trade or business. Number two, the trade or business is regularly carried on. And number three, the activity is not substantially related to the carrying out of the organization's exempt purpose. So it's not going to be related to what your main purpose that you are a tax exempt is for. So next, we're going to kind of dive into each one of these to determine what exactly each of these items mean. So determining when an activity is considered a trade or business. There are several different factors that go into this. And again, it's a multiple of these. It's not just one or another, but really it's, are you creating an activity for a profit motive? And so that would include the manner in which the activity is carried on. Are you conducting it in a business-like manner like any other for-profit entity? The expertise of the organization, is someone within your organization studying this specific activity? Are you consulting with other professionals that are conducting this type of activity? The time and effort expended into this activity. For example, are you hiring a bunch of qualified employees to work in this specific activity versus your other programming? How much time and resources are you devoting to this activity? The expectation that the activity is going to appreciate, that the profit motive appears to be from an increased resale value rather than operations. Successful experience in carrying out the activity. Has the organization been profitable in the past? Now, just because an organization may or may not actually make, or an activity may or may not make money, doesn't necessarily mean that there is not a profit motive included. But that is one thing to look at, is the history of the income and losses on the activity. The amount of profit earned, is it always very profitable, or some years less, or maybe a loss incurred? The financial status of the taxpayer. So again, no single factor is determinative, and other relevant factors aside from these may also be taken into account in determining whether the activity is conducted with a profit motive. But basically, if you are going in and wanting to make money and you are conducting this in a business-like format, it's probably going to have a profit motive. And that kind of takes us into the next item that I want to talk about, is the commerciality test. So the commerciality test really talks about, is another for-profit company doing a similar activity? Is your activity carried on in a manner just like any other for-profit? If it is, then it's likely to be considered a trade or business. If it looks like a duck, sounds like a duck, it usually is a duck. So if it looks like a business an activity that any other for-profit entity would be doing, it probably is a business activity. Some items that are factors that are considered when looking at the commerciality test is, again, the manner in which the activities are conducted, the existence of profits, competition for-profit commercial entities, the extent and degree of below-cost services, pricing. So are you pricing it just like any other for-profit, that type of thing. So again, if you're conducting an activity that looks like a commercial business, that probably would be a commercial business. Aside from you being a nonprofit, then it probably is a trade or business. Next, we're going to talk about regularly carried on. So again, there's three things. This is the second item that must be in place in order for the activity to be considered unrelated business income. So activities are considered ordinarily or regularly carried on if they have a frequency and continuity and are pursued in a manner comparable to similar commercial activities of non-exempt organizations. So what does that mean? So for example, if you have an annual fundraising event, which a lot of nonprofits do, that usually is not considered regularly carried on business or activity. However, though, if this event includes significant planning, preparation, and promotion that begins, several months prior to the actual event, the event may be considered regularly carried on. So again, if you have an annual fundraising event and you spend a small amount of time preparing for that event, it's probably not going to be considered regularly carried on. However, if you have this big event each year and you spend all year planning for it, it may be considered regularly carried on. One issue with the regular carried on is advertising. So we're going to talk about advertising a little bit later, but advertising is normally considered unrelated business income. So when it comes to determining if something is regularly carried on, An organization may have an annual directory prepared and distributed to its membership. So maybe it's a membership organization, and each year they print up this directory. And in this directory, they go out and buy sponsorships or ads from, or purchase or sell, I should say, sponsorships or ads from different entities. Although the directory is only published once a year, it may be considered regularly carried on because, again, the amount of time that the organization works on the directory, maybe for several months prior or maybe even the whole year, it may be considered regularly carried on because of the time, again, that is put into the activity. Some organizations may conduct similar activities, maybe not the same activity on a recurring basis, but similar. They're not identical, but they are similar. And if you do something like this, the IRS has decided that yes, would be considered regularly carried on. So for example, let's say a nonprofit organization conducts 4 different annual events. Let's say they have a spring baseball tournament, a summer basketball tournament, a fall football tournament, and a winter hockey tournament. Although each of these events is only held once a year, the organization is consistently and systematically organizing and promoting similar events. Each of the activities is not regularly carried on when considered separately, but when considered all together with similar activities, the overall activity is regularly carried on. So if you do conduct activities only once a year, but there are other similar activities that you're doing, you might want to just keep in mind that could also be considered regularly carried on. There's also seasonal activities. Again, if you have a activity that's only conducted during a certain time of year, but it is done every year, it may or may not be considered regularly carried on. For example, let's say a nonprofit soccer association operates snow cone stands during the year from Memorial Day to Labor Day. So that's about 25% of the year they're going to be operating this snow cone stand to raise money for the uniforms for low-income families. So although the activity is only conducted during 3 months of the year, it is likely still considered regularly carried on, especially if commercial snow cone stands are also operated only during that same time frame again. But again, there are different other circumstances that are going to come into play to determine whether it is UBIT or UBI, but in looking whether it's regularly carried on or not, something that is considered for that amount of time, very similar to the same operations as a for-profit, is probably going to be considered regularly carried on. The third item that must be in place for an activity to be considered unrelated business income is that the activity must be unrelated to an exempt purpose. So there has to be some kind of relationship to this activity to achieving the organization's exempt purpose. Just because this activity raises money that is then used by the organization to do its programming and to achieve its mission does not mean that it is related to its exempt purpose. It must also contribute importantly, other than through the production of funds to achieve the organization's mission. So the IRS does not care what you're going to do with the money. It cares on how you got that money. And it's going to vary from organization to organization. So again, one organization might have an exempt purpose for XYZ, another organization might have exempt purpose might be ABC. So different exempt purposes, same activity may be considered related or unrelated to the exempt purpose. It also, in determining whether it's related or unrelated to the exempt purpose, it depends on the extent of the activities. For example, let's say that an agricultural department in a nonprofit university operates a dairy to facilitate its research in organic milk production. So that's what its main purpose is. It's research of organic milk. So A 100 cow herd is reasonably sufficient to meet the research needs. So that's directly related to their exempt purpose. That's not going to be unrelated business income. However, because the premium price commanded by this organically produced milk, the department maintains a 250 cow herd. Since they have more cows and they're creating more income than needed just for the research purposes, that additional income is going to be considered unrelated business income. Only 40% of the herd is required for the conduct of the dairy's operations exempt purpose. 60% is going to be considered unrelated business income. So again, looking at the size and the extent of the activities, how much of that activity is actually related to your exempt purpose, how much of it is actually needed by your exempt purpose compared to the excess. So it may be the activity may be a combination of both unrelated business income and not unrelated business income. Also, when looking at items, activities that are related or unrelated to the exempt purpose, sometimes we again have circumstances where it's going to be dual use. So for example, a facility may be used for both exempt purpose activities and unrelated commercial functions. When there's dual usage like this, the use for exempt functions does not by itself make the commercial activities a related trade or business. The test is whether the activities contribute importantly to accomplishing the organization's exempt purpose. So you have a building, part of it is used or rented out for unrelated commercial functions, part of it is used for your exempt purpose. Just because part of that building is used for exempt purpose does not mean that the whole activity is for exempt purpose. And we'll talk about this a little bit more when we talk about rent income later, because that's a big issue when calculating rent. So now that we know specifically the 3 items that must be in place for unrelated business income to exist, there are certain activities that are specifically excluded from the definition of an unrelated trade or business, even though those 3 instances might exist. So you might have activities that are a trade or business that are regularly carried on and that are not related to the exempt function. However, the IRS has come out and said, these specific activities are excluded from unrelated business income. And so what are these? So unpaid volunteer labor is a big one. So if most of the activity is being done by unpaid labor, then that does not meet the definition of unrelated business income. It is not unrelated business income. Now, unpaid volunteer labor does not mean that you can just not pay your employees to do something. So let's say that you are going to have an event on the weekend and your employees are going to donate additional hours or voluntarily participate in this activity outside of the normal workday. That does not count as volunteer labor. However, you could have some paid staff directly involved with the activity and providing like oversight or assistance, but you have to have sufficient volunteer labor also present. There's not really a definition of what that volunteer labor percentage is. However, other areas of exempt organization law use the guideline of 85% measured by the hours worked. So for example, if you have an event and you are using your paid staff, but as long as you have at least 85% of the work being done by volunteers, you're probably okay to be considered that activity being done by volunteers. Then it would not be considered unrelated business income. Other instances that activities that are not considered unrelated business income is when the activity is conducted primarily for the members' convenience. This applies to 501c3 organizations as well as governmental colleges. Members also include students, patients, officers, employees. So again, if we have an example where a nonprofit hospital owns a parking garage adjacent to its facilities, public parking is available, but the purpose of the garage is to provide a convenient, secure parking for patients and visitors. A fee is charged for the use of the garage. So when I go into the hospital and I park there, I'm going to have to pay to use the garage. However, this is not it is exempt from unrelated business income, the revenue from the parking garage, because that parking garage is for the convenience of the members, those people going to the hospital. Some other items, activities that are specifically excluded from unrelated business income, when substantially all the sales are from donating merchandise. So like a thrift shop, if a nonprofit has a thrift shop and all of the items sold are from donated merchandise, or I know some nonprofits will have a garage sale. Most of the merchandise is donated, so therefore it's not unrelated business income. There's also some qualified public entertainment activities and conventions and trade shows that are carried on that are specifically excluded from unrelated business income. There are some specific requirements that must be done, must be held, but those are just some other items that are specifically excluded. And then games of chance that are operated by unpaid volunteer. This would be like bingo, pool tabs, raffles, that type of thing. And then bingo itself is excluded if it's conducted by an exempt organization. However, there are very specific requirements as to what bingo is. So if your organization does bingo or is thinking about doing bingo, just make sure you look into what the actual definition of bingo is. And then also distributing low-cost items in return for donations. So for example, if you send out an annual funds letter to people and in the solicitation you include maybe some return mailing labels with the donor's name and address on it, the money that you receive from that donation, from that annual fund letter would not be considered unrelated business income just because you gave them the little address label stickers. Because it's a low cost item, they didn't ask for it, that type of thing. So if you have little small items like that, not unrelated business income. In addition to activities that are specifically excluded, there's also income that the IRS has specifically excluded from the definition of unrelated business income. These include interest and dividends. So the interest dividends that you earn on your bank accounts, your investments, that's not unrelated business income. Royalties, rent income that is not debt financed. So again, we're going to talk about rent income a little bit later, but if it's just rent income from property that has no mortgage on it, you're good. Gains and losses from the disposal of property. So your fixed assets, if you sell those and you get money proceeds from that, that's not unrelated business income. And then also research income. Just note that there are some instances when the exclusion does not apply to these items, some specific unusual circumstances, but in general, if you have these income items, they are not considered unrelated business income. Okay, so now we're going to talk about a couple common items that could be considered unrelated business income. Rent income is a big one. So rent income from real property. So this would be from your buildings. We're not talking about personal property now. We're just talking about real property. So if you rent out a building, it is excluded from unrelated business income. However, if you have a mortgage on this building, it is considered unrelated business income. Or if the rent is from a controlled corporation, or if the rent is calculated as a percentage of the tenant lease's net income. So you're leasing it to someone, another organization, and this organization is going to pay you rent based on their income, it's unrelated business income. And then also, if more than 50% of the rent is attributable to personal property leased with the real property, so you have a rent agreement, and in that rent agreement, it includes both the use of a building, but then also personal equipment. So maybe furniture, fixtures, that kind of thing. If more than 50% of that rent is for the personal property, then we're going to have some unrelated business income there as well. Rent income from personal property. So this is your fixed assets that are like furniture, equipment, those type of things. it's normally going to be included unrelated business income unless it is leased in conjunction with the real property. Again, if there is a lease that includes both real property, buildings, and personal property, then there's going to be probably some unrelated business income included in there. And then also, if the rent received as a result of the personal property is incidental, then it's probably not going to be unrelated business income. So if we have a mixed lease, one that includes both real property and personal property, all of the rental income is excluded from unrelated business income if the portion of the lease attributable to personal property is incidental to the total payments. Incidental means 10% or less of the total rents received. Okay, so if you have a lease and it has personal property and real property, but it's a very small amount, less than 10%, then we're going to say that it's not unrelated business income. If more than 50% of the total rent received under a lease agreement is attributable to personal property, all of the payments received are included in unrelated business income. So thing to remember here is that if you have a lease, if you're leasing property to someone else, just make sure that lease, that you understand how much of that lease is for personal property versus building. And then just determining the percentage, and that you may or may not have unrelated business income with that as a result of this lease. So one of the things that we said is that rent income from the rental of real property, buildings, is included in unrelated business income if it is debt financed. So what is debt financed? And this actually, this rule applies to all nonprofits, even churches. So I know churches also will lease out facilities. So if you are a church and are renting out a building that has a mortgage on it, you may have to pay unrelated business income taxes. So debt financed property. Generally, debt financed property is any property held to produce income. So you're renting it. So you're getting rent income off of it. It's held to produce property. And with acquisition indebtedness at any time during the year. So if you had the mortgage at the beginning of the year and it was paid off at the end of the year, that's still considered debt financed for the year. When talking about the rental income of a building, if substantially all of the property's use is directly related to the performance of an organization's exempt purpose, it is not considered debt financed property. And again, we're talking about the actual activity, not just funding the exempt purpose. Substantially all is defined as 85% or more of the use of the property, calculated based on facts and circumstances. So these facts and circumstances may include comparing the total time the property is used with the time used for exempt purposes, comparing a portion of the property used for exempt purposes with the portion of the property used for all purposes, or a combination of both of these. So if less than 85% of the use of the property is devoted to an organization's exempt purposes, only the portion of the property used to further the organization's exempt purpose is not considered debt finance. Okay, so what does this mean? So let's say we have a nonprofit who owns a 7-story office building. They acquired with borrowed funds, so they have a mortgage on it. Each floor has equal footage. The bottom floor is leased as retail space, and its use is unrelated to the tax exempt purpose. So the remaining floors are used by the organization in its exempt function. Although the building was acquired with debt and has a mortgage on it, it is not considered debt finance property because substantially all of the use of the building is for the exempt purpose. So if you have 7 floors, equal square footage in each of those floors, and 6 of those, so 6 out of 7 floors are used for the exempt purpose, then that's more than the 85% rule. So then that means that the income from leasing the first floor is not considered unrelated business income. Now, if we have that same nonprofit Same 7 floors, but now they're leasing out the second and third floors of the building are also rented. So they're leasing out 3 floors. Since less than 85% of the building is now being used for purposes substantially unrelated to the exempt function, it would be considered debt finance property. So again, very you have to look at the facts and circumstances surrounding each of the different activities. And because there are different circumstances and different portions of property that are going to be used for exempt purposes versus unrelated purposes, there is a computation to determine the amount of debt financed income. So if you are leasing a building and let's say you're leasing it for, and you get $10,000 of rent income for the year, and it has a mortgage on it, you're probably not going to recognize the full $10,000 as unrelated business income, because in this calculation, we have to look at the average mortgage and the average cost or adjusted basis of the property to come out with a percentage of that $10,000 that is going to be considered unrelated business income. So just know that it's not just a straight, this full $10,000 is going to be my gross unrelated business income. There is a calculation that has to be done. So the next specific type of unrelated business income I want to cover is advertising, because again, advertising is a very common activity done by a lot of nonprofits. Advertising may be done in a periodical or a newsletter that's published or produced by an organization. It might be on the website, it might be in emails going out. So all different kinds and ways to advertise. Advertising is normally unrelated business income unless the income has a direct relationship to the exempt purpose. And that is very rare that that actually happens. So in order to determine if we have unrelated business income from advertising, we really first have to make sure we understand what advertising is. So advertising is defined as any message or material that is broadcast or transmitted, published, displayed, distributed by the organization that promotes or markets any trade or business or any service, facility, or product. So it's going to include messages, qualitative or comparative language, price information, indications of savings and endorsement, trying to get people to purchase items from this advertiser or use their services. If you are just listing or acknowledging your sponsors with their name or logo, that is not considered advertising. So there has to be some type of additional information that is trying to get people to use their services. However, the more benefit that the sponsor or advertiser is expected to get, the revenue, it really pushes that revenue to be considered unrelated business income. Again, advertising revenue is not considered unrelated business income if it is produced in an activity that is not regularly carried on, substantially related to the exempt purpose of the organization, or conducted substantially by volunteers. So if you're doing advertising and it's all done by volunteers, it doesn't meet the general definition of an unrelated business income activity. So it's not going to be considered unrelated business income. But normally, under regular normal circumstances, advertising is considered unrelated business income. Unrelated business income from advertising is calculated by using the gross advertising income, so the gross amount that you receive for that advertising, but you're also going to be able to reduce it by advertising costs. Circulation income also is included, and then readership costs. And that kind of relates, those last two relate to the bulletins or the quarterlies, those type of maybe membership directories that are put out by the nonprofit, looking at how many people are actually looking at those types of advertisements. Now, a lot of nonprofits have a website, which is great. You want to advertise and put out there what your organization does. You just have to really be careful as to what you're putting on your website when it comes to links and banners to other organizations and businesses. So if you have a link, maybe on your website, you are listing all of your sponsors, your donors, and you just have their name, but you have a link to their website. If someone were to click on that link and it were to bring up the business's website, and on that website that was pulled up, it was a huge advertisement to come buy this with us, use our services, that would really be considered advertising income. So we want to make sure that we're looking at those links every so often to make sure that the link that is on our website, look to see what it's bringing up. Is it an advertisement, or is it just a link to that business's website? So some organizations don't have advertising, but they have sponsorships. So sponsorships are different than advertising. More often though, if you call it advertising and it looks like advertising, it probably is advertising. But if you truly have a sponsorship, you want to make sure that you call it a sponsorship. So a qualified sponsorship payment is a payment by an entity engaged in a trade or business. So your sponsor, so a for-profit business, they're making a payment to you as a nonprofit. However, they are not expecting to get anything in return, at least not any substantial return benefits. The substantial return benefits could include advertising. So if they are expecting to receive some type of advertising in return, then it is not considered a qualified sponsorship payment. If the sponsorship is an exclusive provider arrangement, then that is not considered a qualified sponsor payment. Exclusive provider arrangements are typically structured as follows. So let's say a company agrees to pay a university, a nonprofit university, a certain amount of money in a multi-year deal if the university agrees to permit only the sale of this sponsor's products in campus vending machines or cafeterias and at sporting events. So it really is keeping other competitors off of the campus. So this arrangement is limiting the sale and distribution of competing products. And so they are really getting, that sponsor is getting a benefit, from a substantial benefit from doing this. And so they say, nope, this is not considered a qualified sponsorship payment. However, if an organization were to receive a sponsorship from a for-profit company and they were going to say, okay, you are our exclusive sponsor for an activity, that's fine. We're just saying, okay, we're acknowledging that this ABC company is our exclusive sponsor of the activity. That's fine. That can still be considered a qualified sponsorship payment. It's when those substantial benefits that come in that are limiting other companies under the circumstances. There are also some de minimis exceptions allowed for qualified sponsorship payments. So in general, a qualified sponsor, you can't receive any type of benefit. However, there are some small exceptions to that. Also, again, you can recognize the sponsor's name, you can use their logo. That's perfectly fine. That is not considered advertising. However, if the payment is contingent upon the amount of public exposure that's going to be received, then that's going to be considered advertising. So if you have a sponsor that says, okay, I'm going to give you X dollars if you have so many people come to this event, then that's going to be considered advertising revenue as opposed to a qualified sponsorship payment. So when you're dealing with advertising and sponsorships, you just want to make sure that you're recording it properly. Okay, is it advertising or is it a sponsorship? Advertising is probably going to be unrelated business income. Sponsorship is not, but we need to make sure that what the payer is getting in return actually is or is not allowed under a qualified sponsorship payment or under advertising. So some organizations will operate more than one unrelated trade or business. So some might have rent income from debt finance property, they might have advertising. And before 2017, you could net those together. So if you had a loss in one activity and an income on another activity, you could net those together. The loss could offset the income. However, that is no longer allowable. The IRS said, no, we can't do that anymore. So you have to identify each activity individually. And so we need to track that activity separately for each activity. When reporting the information to the IRS, we also need to look up what specific code. It's a NICS code that is that relates to that activity so that we can report it. So just if you do have more than one activity that you think is an unrelated business income or trade activity, just make sure that you're tracking those items separately. So along with that, when we determine if we have unrelated business income, so we have income from this activity, we're going to have to pay taxes on it. However, we're going to be able to first reduce that income by any related expenses. Oftentimes, our expenses relate to both unrelated business income and activities that are related to the organization. So just like when you're allocating your expenses between program, management in general, and fundraising for your 990 or for your financials, we have to allocate expenses some expenses to that unrelated business income activity. So these expenses obviously must have a relationship to the unrelated business income activity. We can't just be allocating across the board 10% of all of our expenses to this activity, because more than likely D&O insurance probably doesn't relate specifically to this activity. Other certain expenses probably are not going to relate directly to this activity. So we can't just do a straight across the board allocation. So we need to have some kind of reasonable allocation method in place. Oftentimes these are based on space or time or units. Just like when we're allocating between program, management in general, and fundraising, we have to come up with some basis to allocate these expenses to the unrelated business activity so that we can reduce that income. Now, the allocation of expenses based on the amount of revenue generated is not, you can't do that. That is not a reasonable application. For example, an activity may generate little or no revenue, but you're not going to not allocate expenses to it. So for example, one of your program activities, you might not charge fees for it, but it's a program that you need to do. You're not going to say, okay, we don't have any costs associated with that. So you just want to make sure that there's a reasonable basis in allocating these expenses, and it should be consistent across the board once you determine what those bases are. So if you do have unrelated business income, you are required to report the activity to the IRS on Form 990T. So at the end of the year, you file a Form 990 to report your activity to the IRS. So if you have unrelated business gross income of $1,000 or more, there's a second form that you have to file. And it's called the Form 990T. It is due the same time as your 990 is due. If you need more time to file it, you can file an extension. However, if you had to file an extension, you're going to have to determine the estimated amount of taxes that you're going to have to pay, because you might have to make a payment with that extension. So just like corporations that pay income taxes, you have to pay unrelated business income taxes on this unrelated activity. 990T is also required to be e-filed, so you'll want to have an accountant or someone that has the e-file capabilities to file that with the IRS. In addition, if you have unrelated business income taxes that you expect to be more than $500 during the year, you're going to also have to start making estimated tax payments throughout the year on that. And the 990T again is the federal form. So there's also a state form. It's called the IT-20NP that must be filed with the state of Indiana. So you'll have to pay some state taxes as well, just like a corporation that pays federal and state taxes. You have to pay both to the federal and the state for that. So that is all that I have so far on unrelated business income. So really, just if you do have activities that are not related to your general, what you are exempt for, you might want to just consider looking at those, making sure that they aren't unrelated business income. I know a lot of nonprofits during the pandemic started looking at new ways to generate income, which is great. But when you're creating those new revenue streams, again, you want to make sure that if those are unrelated business income or not. And again, having unrelated business income is fine. It's okay to have unrelated business income. You just can't have an excessive amount. If it gets too excessive, the IRS is going to say, okay, hey, wait a minute, you're not doing what you said you were going to do as a tax exempt organization. You're running a business, therefore you should not have your tax exempt status anymore. And again, unrelated business income is fine. You're just going to have to pay taxes on it. And sometimes, that's great because the amount of revenue that you're bringing in is worth paying the amount of taxes that you have on it. I don't know if anyone has any other questions at this time. Amanda, did you want to wrap it up?
Yeah, I just wanted to take this moment to thank everyone so much for joining us today and for being flexible. I know some of you had to probably juggle your schedules a little bit since we had to reschedule from Tuesday. As always, please be sure to follow us on LinkedIn. We always share our new webinar RSVPs on there, as well as visiting the nonprofit education web section of our website. And we should have the video recordings of this session as well as the slides available later today. So feel free to share them with anyone that you think might find this valuable. Thank you so much. Have a great day.